Hey everyone, welcome back to Corporate Decoder, the place where we decipher the world of business from the most exciting tech trends to the nitty-gritty of corporate finance. Today, we're diving deep into a Form 10Q filing from the Glimpse Group, Incorporated. Ticker symbol VRA. Now, this report covers their financial health, and let me tell you, there are some interesting swings in their numbers that paint a vivid picture of where this immersive tech company is heading. If you appreciate getting straight insights from corporate documents like this one, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings even further. So come join the conversation. Alright, let's cut straight to the chase, the financials. This filing gives us a look at their performance for the 6 months ending the 31st of December 2025 and how it stacks up against the same period in the prior year. And wow, the revenue numbers show a significant drop. Total revenue for the 6 months ending the 31st of December 2025 came in at about $2.7 million. That is a substantial decrease from the $5.6 million they reported in the same period in 2024. This is a massive 52% drop. To put that in perspective, it is like losing more than half of your customer base or half of your sales within a year. Digging into the details, it is clear that their software services revenue is the main driver of this decline. For the 6 months ending the 31st of December 2025, software services brought in about $2.4 million, down from over $5.3 million in 2024. That is a 55% drop. The company blames this on timing issues with government contracts, specifically with the Department of War and general budget delays. They also mentioned that some older legacy customers are no longer contributing as much, which is a consequence of their strategic shift to focus on newer technologies like spatial computing. On a slightly brighter note, their software license and software as a service revenue actually held steady. It was about $250,000 for both the 6-month periods in 2025 and 2024. This is good stability in a tough quarter, and they've even added a new revenue stream from royalty income, bringing in about $0.03 million in the 6-month period of 2025, which is a welcome addition. Now, let's talk about profitability. The gross profit margin, which is basically how much money is left after you subtract the cost of making your product or service, has also seen a dip for the 6 months ending the 31st of December 2025. It was around 67%, down from 70% in the same period in 2024. This small but noticeable drop is mainly attributed to changes in the cost structure of those government projects. Despite the revenue decline, their spending on research and development actually increased slightly. For the 6 months in 2025, it was about $1.87 million, up from $1.78 million in 2024. This 5% increase might seem counterintuitive when revenue is falling, but it could suggest the company is investing in its future technologies, which is common for tech companies trying to innovate their way out of a slump. On the other hand, their sales and marketing expenses have significantly decreased. For the 6 months ending the 31st of December 2025, they spent about $0.63 million on sales and marketing, down a huge 44% from $1.12 million in 2024. Core businesses like Creel and a general reduction in marketing efforts that were tied to revenue, which makes sense when revenue is down. Another big drop is in amortization of acquisition intangible assets. This expense went down by 74% for the 6-month period, from $0.23 million in 2024 to just $0.06 million in 2025. This is likely because some of the intangible assets they acquired have reached the end of their useful life and are no longer being expensed. All these factors combined resulted in a significant net loss. For the 6 months ending the 31st of December 2025, the company reported a net loss of about $2.26 million. This is a big jump from the net loss of just under $1 million in the same period in 2024. The reduced revenue and gross profit are the main culprits here. When we look at their adjusted EBITDA, which is a measure that tries to show the operational health of the company by excluding certain items like stock-based compensation and gains or losses from asset sales, the picture is also concerning for the 6 months ending the 31st of December 2025. Their adjusted EBITDA was a loss of $1.83 million. This has widened significantly from a loss of $0.17 million in the prior year period. It shows that even when you strip out some of the one-off expenses, the core operations are struggling more this year. Looking at cash flow, the company used a lot more cash in its operations. For the 6 months ending the 31st of December 2025, they used about $2.03 million in operating activities, a massive 7-fold increase from the $0.25 million used in the same period in 2024. This is a direct reflection of that revenue drop and the associated impact on gross profit. In investing activities, there is a big jump in cash used. For For the 6 months in 2025, they used $1.52 million, largely due to a final payment of $1.5 million for an acquisition. In the prior year, they only used about $0.03 million. This shows a significant outflow for a specific acquisition. Financing activities also saw a huge change, but in the opposite direction. In the 6 months of 2025, they had about $0.06 million provided by financing, which is a tiny amount compared to the $6.87 million provided in the same period in 2024. That big number in 2024 came from selling stock to institutional investors. It seems they tapped the equity markets heavily then, but not so much this year. As a result of all these cash outflows, their cash position has significantly decreased. They ended the 6-month period in 2025 with $3.34 million in cash, down from $8.44 million at the end of the prior year period. That is a 60% drop in their cash reserves in just 6 months. Now let's turn to the balance sheet and see how things look there. As of the 31st of December 2025, the company had about 21 million shares of common stock outstanding. That is a slight increase from the 18 million shares outstanding at the end of 2024, reflecting some share issuances. Their additional paid-in capital, which represents the money shareholders have paid for stock above its par value, stands at a very healthy $83 million as of the 31st of December 2025. This shows a significant amount of capital has been injected into the company over time, likely from stock sales. However, the flip side of that is their accumulated deficit, which is the total net losses the company has incurred since its inception. As of the 31st of December 2025, this stood at a staggering $67.8 million. This is a classic sign of a growth stage company that has been investing heavily, but hasn't yet become consistently profitable. One interesting item on the balance sheet is the contingent consideration for acquisitions. As of the 30th of June 2025, they had about $1.5 million in this liability. By the 31st of December 2025, this had dropped to zero. This likely means they've either paid off a significant portion of this liability related to past acquisitions, or it was resolved through other means. Looking at the overall trajectory, Glimpse Group seems to be in a period of significant transition. They've divested some non-core assets like Creel and Pose with the Pros, which has impacted their top-line revenue and cash flow. They're also making strategic investments in areas like Spatial Core, which they believe will be a key growth driver. However, the substantial drop in revenue and widening losses are undeniable headwinds. The large accumulated deficit and significant use of cash in operations highlight the financial pressure the company is under, while they have raised substantial capital, evidenced by the additional paid-in capital. The profitability picture is still very much a work in progress. The government contract timing and budget delays are external factors, but the internal strategic shifts and divestitures also play a major role in their current financial state. So, what is my take on this? Glimpse Group is definitely a company operating in a high potential, but also highly volatile emerging market. Their strategy to focus on spatial computing and AI is forward-looking, and the investment in R&D is a positive sign. However, the significant decline in revenue and worsening net loss are serious concerns that cannot be ignored. The substantial cash burn needs to be closely monitored, and the company's ability to execute on its strategic pivot and leverage its new technologies will be critical for its future success. The risk factors mentioned in their filings, especially related to market adoption of immersive technologies and their ability to secure further funding, are very real. Alright, that is our breakdown of the Glimpse Group's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord community link in the description below. Thanks for watching. See you next time.